Rajat Monga, Group President, Financial Markets and CFO at Yes Bank, joining us on NDTV. Profit, thank you very much for joining us. Asset quality has been pretty stable. There's a marginal pickup in the gross non-performing assets. Where do you see stress? Which sectors?
The stress that, if you may say, the banking sector is observing is a little bit of a legacy of the growth cycle that the economy experienced in the 3, 4, 5 year ago sort of seeding of growth that was being done, and that again was dominated by infrastructure assets between power and roads, as well as some industrial sectors. The stresses in the banking sector continue to be referenced with the let's say the growth in the last cycle, which has still not been fully absorbed by the growth of demand. And an additional sort of play has been thrown in because of the commodity price fall in the last 12 to 18 months, which has resulted in some of the operating metrics of commodity companies, particularly the iron and steel sector, suffering as a consequence. And which is where the broad range of stress can be narrowed down to as far as the Indian economy or the Indian banking sector is concerned. And Yes Bank has been navigating these issues pretty regularly and predictably. We have not done any large project financing because, as a philosophy, we don't go participate in large consortiums as a small participant. So we have stuck to our own leadership, but in doing smaller financings. That has helped us sort of stay clear of some of the core issues. While we will have minority exposures here and there, but we are not referenced to the very large infra or the very large industrial sort of outcomes that we are seeing in terms of stress at this point in time. In fact, Yes Bank has been utilizing the opportunity to de-stress some of these situations because of having been our ability to identify the good assets in these situations, assets that can be carved out and put back in terms of financial de-stressing. There have been tremendous opportunities that the banks have sought even on this sort of revival scope of in the Indian corporate sector, and that part will continue as M&A, as new equity comes back into this. And you will see the bank hasn't had to do any 525, any SDR, any sales to ARCs. That's because the inherent sort of structuring, client choices, and the risk management that the bank has been doing has been held in very good stead.
Okay, of course, what's been noted is the fact that there's been no sale to ARCs, no 5x25. What were the write-offs in this quarter?
Yes, there will be write-offs, and they happen all the time. So the write-offs also means that we also take higher provisions, because before writing off, you have to take provisioning to 100%, because that is an effective write-off. And there will always be some plus and minus, and there have been influence of write-off in this quarter as well.
Can you give a number?
Well, last quarter was possibly very low on write-offs. This quarter it would be, I'm guessing it would be close to a high single-digit basis points that the write-off will compromise.
Okay, can we expect higher provisions ahead?
The near-term guidance that the bank has been offering is about the expected credit cost, including the next quarter as well as for the full year. So what we've done after declaring the results, or as part of the results of the third quarter, we have also reduced our full year credit cost guidance to 50 basis points or lower. This used to be between 50 and 70 basis points till the second quarter. And the 34 basis points has already been provided for in the last 9 months.
Okay, you're talking about reducing the credit cost guidance. Just break down how that works, the lowering.
The guidance actually has been reduced because 9 out of the 12 months are already there for us to reckon with. When we give a guidance, the beginning of the year, it is a range because there are full 12 months of outcomes that we have to be estimating. But as of right now, we already have hard numbers of the last 9 months. So we are estimating the outcomes of only one quarter, and therefore we have to sharpen our range. So what was a wider range has now been put more to a fixed number or closer to a fixed number than it has been in the past, because the year is almost over. And we also have the benefit of 29 days of this year, which is also of this quarter rather, and this month, that is also behind us effectively.
Okay, Q3, strong growth in advances. Has the demand scenario improved?
If you look at the perspective from where we look at growth, we are looking at us, which occupy about 1.25% of the market share of the, let's say, the lending opportunity in India. There are enough complexities with various banks in terms of their own current lending books, which we've been discussing. There are credit situations, banks are going slow. There are capital compulsions. For growth, banks need proportionate capital. So where we are finding ourselves is in a very peculiar position where we are getting a look into a very large growth opportunity because of the last 12-13 years that the bank has put behind us itself. The bank has created a lot of reach. So we have access to most of opportunities that become available in the banking space in India. We are additionally growing into the retail space, which have so far been let's say, more in development space, in the development zone as far as Yes Bank is concerned. So we have now access to a very wide range of growth opportunity. The growth doesn't have to be through new projects. The growth can be through increased working capital. It can be through refinancing or repackaging. You are seeing M&A taking place in the Indian economy. We can bank the buyer. You've seen most banks are running away from electricity sector, but we are actively doing business in the renewable energy sector because we have room, we have the skills, and we have the confidence when we look at renewable energy sector to do banking there. So there will be very peculiar sort of situations that will run. And for a smaller size, mid-sized bank like us, I think there is a clear opportunity to win more market share and do that with good credit judgment. Thankfully, today, most of the risks related to lending are already on the table. Very few new investments have taken place in the economy in the last 2-3 years, which means that no new risks have been put on banking sector books. If at all, old risks have cured. They have become better or they have become worse, and that intelligence is there on the table today. So banking has become more de-risked as a growth sort of opportunity. You have more risks when you're growing and giving money to new projects and don't know whether they will complete, whether there will be demand at that point in time. So the risk metrics of lending actually have become better, and it's just that confidence levels are low, and we are finding opportunity, a great deal of opportunity in this market gap.
Okay, couple of final thoughts from you. What's the scenario as far as banks are concerned, the mindset? Are they cautious right now in lending, or there aren't actually that many new projects coming up?
I think it's all a concurrent outcome. If banks are cautious, the owners who want to put projects or the sponsors who want to put projects may not be confident of getting financial closures. So it is, like you said, there is a sentiment play, but we also can be a little bit of a contrarian play as well. Like I was describing to you, renewable energy is again a classic case in point. Most banks have colored power with the same brush, and they're saying that power sector we are high on exposure, there are problems. But renewable energy is a great exception. It is power, but the metrics of renewable energy are only improving with every passing day. So there are opportunities, and we do command a very good share in the Indian renewable energy lending space. I mean, we have been working on clean energy for a while, and it has also culminated into lending opportunity in these times. And we can take a view that power sector is improving, and government is working to cause further improvements in the power sector. Coal supply has improved, gas supply has improved, coal stocks have improved, import prices are down. The PPAs are being signed, old PPAs are getting resolved. Solar energy is being bid for at 4.5 rupees, which is like close to grid parity. There are several concurrent conditions which point to good, let's say, prospects in these businesses. But yet we are clouded by sentiment. Clearly we are clouded by sentiment. Indian corporate is also seeing buy opportunities. He's also thinking, when I know there are other sponsors who will sell, why should I take a greenfield risk when I can take more acquisition risk? I will get a ready to operate asset. So a lot of Indian private sector is actually looking to buy. So the new project burden is shifting more to the PSU and the government sector, and you're seeing that. So government has to, so budget becomes very important as to how the outlay for projects and roads and power capacities, how do they get executed in terms of both in the PSU space as well as on the government space. There is a good counter-cyclical, you can say, or a counter-sentiment opportunity.
Okay, I'm going to wrap up this conversation with your guidance for FY17. Let's start looking forward.
The growth should be, you should look at the outcomes like you're seeing in the current quarter, maintain over the next year as well. We have visibility of putting mid-20s to high 20s growth between advances and deposits. We have the confidence that our CASA mix will continue to improve. We are putting more branches. We have added 50 branches on a base of 750 in the just in this quarter. So there is a lot of work being done on the digital space as well. So there is enough reasons for us to believe that our growth momentum can continue.
Well, I'm going to leave it at that. Rajat Monga, thank you very much for joining us on NDTV Profit.